It's the dead of summer, the heat is on in middle America, and it's baseball season. My favorite sport in the week of the Home Run Derby and the All-Star Game. So in that vein, I'm going to give you a doubleheader in our News or Noise segment, making comments on two topics. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group. And this is our investment team's midweek release, when we had examined a news item, headline, or story, making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? We've got a quick doubleheader this week, briefly covering two widely different topics. First up is the news of the newly SEC-approved leveraged single stock ETFs. Our second topic will cover some quick thoughts on recent bank earnings calls. So viewers, first up, yes, I know you've all been waiting years, wondering, when can I buy single stock leveraged ETFs? One that would allow me to trade and make a bet using leverage on how much up or down the stock of, say, Nike, Tesla, or Nvidia might go in a single day. I know you've all wanted a product that would try to magnify your daily investment returns up or down by, say, 1.5 to 2 to 1. Well, you're gonna get your chance. The SEC just okayed a series of these products launched by some firm called AXS Investments for here in the US. These tools have been around for a few years in Europe. Leveraged and inverse ETFs are designed to let investors and traders take bets on a security's short-term direction, giving 1.5, 2, or even 3 times the daily return. In the case of inverse ETFs, 1.5, 2, or 3 times the opposite of the daily returns of a stock. They reset every day, which means a long-term investor in a 2 times fund, for example, would suffer magnified losses on any day when the underlying security's lost value. Viewers, let me be as blunt as my compliance team will allow. In our investment team's opinion, even more so than other leveraged ETF products before them, these leveraged single stock tools are utter garbage. They're trash, they're toxic. The only people in the world who can dream this stuff up as public investment for your portfolio are marketing departments and investment bankers, neither of which deal in investment returns or fiduciary duty. Viewers, just because the SEC okayed them for the market doesn't mean they're appropriate for your portfolio. Below in the description, you'll find a link to what the SEC actually said about these products. A director at the SEC office said this about them, and I'm going to paraphrase it a bit here, but here it is. I'm disappointed that we have not updated our framework to address risky products like these that pose risks to investors and the markets. Viewers, in other words, they say it got approved by the SEC because they backdoored a relaxation in the approval process that happened in 2019. Viewers, even more than other leveraged ETFs out there, take these off the screen. They're very risky and they're news, bad news. The second topic is the news around the recent slate of bank earnings reported last week, particularly the JP Morgan conference call led by CEO Jamie Dimon. We have been a long-term fan of Mr. Dimon and the balance with which he runs the bank JP Morgan. While we do own a few banking stocks for clients, we haven't been bowled up on the group like many others on TV who've been constantly out there parroting that higher interest rates would be a boon for bank stocks. Most of these individuals were recommending being overweight the group the last 12 to 18 months based on almost solely the trend of higher interest rates. Contrary to this, our experience and analysis said that being patient and slow to add to the group for the vast majority of 2021 was the way to go. That earnings gains were reversals of reserves from prior COVID-induced conservative markdowns on their loan books. Recall that even though short-term rates are being raised by the Federal Reserve, even though long-term interest rates have moved higher this year, and even though many bank net interest margins, or NIM, which is the spread they earn, has improved in the last few quarters, a Goldilocks environment for bank stocks requires a steepening yield curve more than anything else. I'll repeat this. Bank stock relative performance is largely dependent on the yield curve movement and shape. The yield curve has been flattening since the first quarter of 2021, and bank stocks have been underperforming. Are bank earnings reports last week news from your investments? Most certainly they are. Why? Not because the numbers they just reported, no, because they importantly tell you about lending, borrowing, capital spending, and consumption, and how the heart of the US economy is doing. And as an investor, you need to look at that and think forward 6 to 12 months to anticipate if these dynamics will look better going forward or worse. Are things going to get better or worse for banks over the next 6 to 12 months? Will their marginal return on invested capital improve from the second quarter levels if we return to a low and slow, boring economic environment in the fourth quarter of 2022 through the first half of 2023? What will happen without the sugar high environment of COVID spending programs of 2020 through early 2021? Or what about the effects of higher inflation, the war in Ukraine, or the Fed? We all get to have an opinion as investors and decide for ourselves. But this is most definitely news for your investments for the next 12 months. I suggest you give this article, and link is in the description below, a thorough read if you're looking at investing in single stocks in the bank sector on your own. This is definitely a newsworthy story. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain in the stock market, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here in Houston at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from everyone here at Oak Harvest, have a blessed week.